What's a bear market? Here's what to expect as stocks skid. New York. Investors on Wall Street need a place to hide. The stock market's skid this year has pulled the S&P close to what's known as a bear market. Rising interest rates, high inflation, the war in Ukraine and a slowdown in China's economy have caused investors to reconsider the prices they're willing to pay for a wide range of stocks, from high-flying tech companies to traditional automakers. The last bear market happened just 2 years ago, but this would still be a first for those investors that got their start trading on their phones during the pandemic. For years, thanks in large part to extraordinary actions by the Federal Reserve, stocks often seemed to go in only one direction, up. Now, the familiar rallying cry to buy the dip after every market wobble is giving way to fear that the dip is turning into a crater. Here are some common questions asked about bear markets. Why is it called a bear market? A bear market is a term used by Wall Street when an index like the S&P, the Dow Jones Industrial Average, or even an individual stock, has fallen % or more from a recent high for a sustained period of time. Why use a bear to represent a market slump? Bears hibernate, so bears represent a market that's retreating, said Sam Stovall, chief investment strategist at CFRA. In contrast, Wall Street's nickname for a surging stock market is a bull market, because bulls charge, Stovall said. The S&P index slipped points as of a.m. Thursday too. It's now down % from its high of on Jan. The Nasdaq is already in a bear market, down almost % from its peak of on November. The Dow Jones Industrial Average is more than % below its most recent peak. The most recent bear market for the S&P ran from February through March. The index fell % in that one-month period. It's the shortest bear market ever. What's bothering investors? Market enemy. No as interest rates, which are rising quickly as a result of the high inflation battering the economy. Low rates act like steroids for stocks and other investments, and Wall Street is now going through withdrawal. The Federal Reserve has made an aggressive pivot away from propping up financial markets and the economy with record low rates and is focused on fighting inflation. The central bank has already raised its key short-term interest rate from its record low near zero, which had encouraged investors to move their money into riskier assets like stocks or cryptocurrencies to get better returns. Last week, the Fed signaled additional rate increases of double the usual amount are likely in upcoming months. Consumer prices are at the highest level in 4 decades, and rose % in April compared with a year ago. The moves by design will slow the economy by making it more expensive to borrow. The risk is the Fed could cause a recession if it raises rates too high or too quickly. Russia's war in Ukraine has also put upward pressure on inflation by pushing up commodities prices. And worries about China's economy, the world's second largest, have added to the gloom. So, we just need to avoid a recession? Even if the Fed can pull off the delicate task of tamping down inflation without triggering a downturn, higher interest rates still put downward pressure on stocks. If customers are paying more to borrow money, they can't buy as much stuff, so less revenue flows to a company's bottom line. Stocks tend to track profits over time. Higher rates also make investors less willing to pay elevated prices for stocks, which are riskier than bonds, when bonds are suddenly paying more in interest thanks to the Fed. Critics said the overall stock market came into the year looking pricey versus history. Big technology stocks and other winners of the pandemic were seen as the most expensive, and those stocks have been the most punished as rates have risen. Stocks have declined almost % on average when a bear market coincides with a recession, compared with a nearly % drop when the economy avoids a recession, according to Ryan Detrick, chief market strategist at LPL Financial. So I should sell everything now. Right? If you need the money now or want to lock in the losses, yes. Otherwise, many advisors suggest riding through the ups and downs while remembering the swings are the price of admission for the stronger returns that stocks have provided over the long term. While dumping stocks would stop the bleeding, it would also prevent any potential gains. Many of the best days for Wall Street have occurred either during a bear market or just after the end of one. That includes 2 separate days in the middle of the bear market where the S&P surged roughly %, as well as leaps of better than % during and shortly after the roughly month-long bear market. Advisors suggest putting money into stocks only if it won't be needed for several years. The S&P has come back from every one of its prior bear markets to eventually rise to another all-time high. The down decade for the stock market following the bursting of the dot-com bubble was a notoriously brutal stretch, but stocks have often been able to regain their highs within a few years. How long do bear markets last and how deep do they go? On average, bear markets have taken months to go from peak to trough and months to get back to break-even since World War II. The S&P index has fallen an average of % during bear markets in that time. The biggest decline since occurred in the bear market when the S&P fell %. History shows that the faster an index enters into a bear market, the shallower they tend to be. Historically, stocks have taken days, months to fall into a bear market. When the S&P has fallen % at a faster clip, the index has averaged a loss of %. The longest bear market lasted months and ended in March and cut the index by %. How do we know when a bear market has ended? Generally, investors look for a % gain from a low point as well as sustained gains over at least a 6-month period. It took less than 3 weeks for stocks to rise % from their low in March. Why you shouldn't try to time a stock market bottom. When the stock market crashes, it impacts people in different ways. Nobody likes seeing their net worth drop, even if it's just on paper, and it's very tempting to want to stop the bleeding and sell your holdings. That's an understandable impulse. When you see your stocks lose value, it's easy to think about selling them simply to stop the bleeding. You can lose any more money if you sell, but that's a very risky attitude. Nobody knows when the market will reach bottom, and the bottom may not happen at the same time for every sector. If you own stocks you believe in over the long term, selling now so you can buy at a lower price later puts you at risk of selling, then having to pay a higher price to buy back in. Stock prices go up and down for reasons that often have nothing to do with the strength of that particular company. Walmart WMT, get Walmart. Report stock, for example, was down about % year to date as of midday June. That's because retailers have broadly warned about higher costs and lower profits. But, do you believe Walmart will stop being a good business because of these issues? The reality is that lower-cost retailers with huge buying power will likely add customers during an economic downturn and keep some of them when things improve. A falling stock price is often not a sign that something is wrong, and it's almost never a reason to sell a stock you have long-term faith in. The question you need to ask yourself about every stock you own is, why is this company in my portfolio? Ideally, you would have asked that question before you purchased the stock, but if you didn't, you should ask it now. What you do depends upon your answer. If you answer, I bought this because I heard on social media that this stock was going to go up, well, you have some homework to do. In this scenario, you need to research the company either on your own or by seeing what professionals think. Be careful when looking at analyst reports from people who are focused on short-term movements. They are often wrong, as predicting short-term stock movements is like betting on what the score of an NBA game will be in the middle of the third quarter. Instead, look for analysts who have a long-term view of the company, or dig in yourself, then ask the question, do I believe this business will continue to be stronger in the future than it is right now? If you believe that's the case, then the current stock price does not matter. Chipotle CMG, get Chipotle Mexican Grill. Report shares dropped significantly for over a year during the company S.E. coli scandal. Long-term investors looked at how the company handled the issue aggressively and made a decision as to whether they believed the damage would be repaired. It was. Selling your Chipotle shares would have been a mistake, as Chipotle has roughly tripled since its lows during the crisis. And, of course, if you bought a stock because you believed in the company, ask yourself what has changed. The pandemic, inflation, and supply chain issues have exposed some companies as not being as strong as many thought. If you own shares of a company you think has large flaws you did not see previously, it may be time to sell. If, however, a good company is struggling due to relatively short-term economic concerns, then you almost certainly don't want to sell. As an investor or even as a trader, it's important to take the financial advice you see on TV for what it is: hot takes designed as television entertainment. Nobody puts you on TV to say stay the course, or buy great companies and hold them for a really long time. The only advantage the individual investor has is time. You don't have access to the same information as the hedge funds and institutional traders. A market crash or a bear market is an opportunity to add good companies to your portfolio at cheaper prices. Be a regular buyer during times like this, and your cost basis for each company goes down. Tune out the noise of the day. Stop trying to time the market, it doesn't work. Remember that you reinvesting for your future, perhaps for retirement, not for today. Losses and share price drops only matter when you sell and if you believe in the long-term prospects of the company you own, you have nothing to fear.